What's up, everybody? Steve Barton here. Thank you for tuning in. If you're liking these videos, please do me a favor, hit the like and subscribe button, hit that little bell notification icon, and you'll be notified of future videos. All right, I read an interesting article in the local paper today that it was a political article. This isn't about politics, but the author wrote something interesting when she talked about inflation. This is her opinion. Inflation, it's a worldwide problem that stems from COVID-19 supply and demand issues, as well as Russia's war on Ukraine. I kind of laughed when I said this, and then I realized she wasn't joking. This made it through the editors to the point to where they printed it, and now tens of thousands of people are going to read this. This isn't meant to make fun. I'm not going to mention the author's name, but I politely disagree. This is an educational show, okay? So this is the simplest way I can think of to explain inflation. Let's say this apple represents all of the goods and services that are available. If there is one apple in existence, this is all the goods and services, and $1 in existence, how much does the apple cost? It costs $1. If there's 100 apples and $100, how much does each apple cost? $1. Inflation is caused when the money supply in an economy grows at a faster rate than the economy's ability to produce goods and services. So, 100 apples, $100, $1 an apple. Now let's say we still have the same 100 apples, but money printer go burr, we now have $200 in existence, but still the same 100 apples. How much does each apple cost? $2, right? $200 divided by 100 apples, $2 an apple, right? Let's say that we have 100 apples and $100, $1 an apple, but now we've gotten really efficient as a society. We're making apples faster and growing them faster than we have before. And now we have 200 apples, but still the same $100. How much is each apple worth? 50 cents. Let's say we've gotten really efficient at growing apples, and we've also doubled the currency supply to $200. How much is each apple worth? $1. Government's response to this is actually printing more currency. They're giving us gas cards so that we can buy more gas. The problem isn't that we don't have enough currency. The problem is we don't have enough oil. We need to increase the amount of oil, and that will naturally bring down the price. But if you have the same amount of oil, money printer go burr, the price is going to go up. It's making the problem worse. So inflation, although government's response to the pandemic did not help, and although the war in Ukraine did not help, it's not the cause of inflation, okay? Here, I'm going to share my screen here. We're going to go to the Fed funds rate, and I will show you the cause of inflation. This is the Fed funds rate dating back to 1954 until present day. This is essentially what the Federal Reserve says, and this is from the Federal Reserve website here, so this is their own data. And we can see over the course of the last 70 years that it's pretty typical to have a Fed funds rate, up a little bit, 5, 6, 7%. Well, let's zoom in here to 2009, 2010, and we can see that money, I should stop calling it money, currency essentially got free to borrow for a very long period of time. From 2009, 10, 11, 12, 13, 14, 15. Okay, so for 6, 7 years, it was essentially free to borrow money. This was the cheapest that it's ever been to borrow money in 5,000 years. It's never happened before in our lifetime. It probably won't happen again. Oh, maybe it will. But my point is, when you make currency so cheap to borrow, there's going to be some radical inflation that follows. Now, look at where we are at here. Okay, we go down to 2022. We start hiking rates, 75 blips. Look at just how fast that has skyrocketed, right? What what happened during this time when money was free to borrow? Corporations, people like yourself, buying a house and borrowing to do it. That that money didn't exist before you bought that house. The bank did not have that $500,000 sitting in their account and they loan it to you and then charge interest on it. It was simply created. They typed it into a computer and they said, now you have $500,000. Pay us that back over time with interest, and then the debt is forgiven. But what happens is they loan this 500,000 out into existence. You pay it back over time. So over the course of 30 years, you're probably going to end up paying 800,000 instead of back half a mil because you got to pay the interest. Now you have that extra currency in the supply. That's what happens when you make money so cheap to borrow. And it happened here again in 2020 to 2022. And look at how fast this Fed funds rate has been going up. If we edit the graph here, and we put the units percent change from a year ago. Now check this out. This is really impressive. Look at how fast this changes. Okay, let me take the graph all the way back out to the 50s again, and you'll see what kind of a parabolic move this is in such a short period of time. Look at how this move went from 1958 until 1959. But look at this one over here from 2022, and we're not even over yet. Look at how fast this has increased. It's essentially gone from 0 to 3.25%, and they're going to raise another 75 basis points here in a couple of weeks. This is the fastest rate of change that has ever happened. That's not going to come without a consequence. I hope you guys got something out of this. If you want to get a hold of me, stevebartonmoney.com. Thank you for tuning in, and I will talk to you next time.